Sticky inflation is back. Euro inflation surge looks great for gold. Hi, everyone, and welcome to another week of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. It's Monday, so Alex is back with us to share her take on all things inflation, rates, and government policy. How are you going today, Alex?
I'm going very well, Chris. How about yourself?
Very well. Happy to be here for another week. Um, read your news today. It was a great piece, and it really showed the inflation story shifted firmly over to the Eurozone. Something that we haven't really been looking at. Like obviously we've talked about it in terms of energy and other things in the past, but we've really been focusing on the US. So it appears they didn't get the inflation relief they were hoping for recently, with the last numbers coming out stronger than expected. And now we're hearing this term sticky inflation being used, enforced repeatedly. So I thought that was quite interesting. And I'd actually like to start there. Could you maybe give us a bit of background of what this term sticky means, and why do we keep hearing it all of a sudden across the media everywhere?
Yeah, so when I was writing this article today, I started looking at Europe and what was going on there. And the terms that are just being used again are sticky on inflation. So the term sticky is basically a term where something can either go up easily, but then it gets stuck and it won't go back down. And that is known as sticky down. Or the opposite, it can go down quickly but won't go up, and that's known as sticky up. So it came into existence when Maynard Keynes was trying to explain what was going on with wages in the 1930s, and basically why they weren't dropping compared to, unemployment was rising, people were losing their jobs, but there was a situation where wages were not following the unemployment down. And the reason was that, his theory is that wages are sticky, in that they'll go up easily because people will ask for pay rises, and, firms, when they're doing well, will give them. But people will fight very aggressively to make sure that their wages don't go down. So
Yeah. You never hear anyone going to the boss and asking for a pay cut, do you?
Yeah, that's exactly right. So it's the term. That's where it came into existence. And I guess they're starting to use it now, again, describing what's going on with inflation, and obviously very different mechanisms, but that is just the term, the asymmetry between up and down in economic variables, I guess.
Yep. Particularly things that like wages, and that makes a whole lot of logical sense if you just think it through. So what's going on in the Eurozone then? Because that was a big focus today. Previously, as I was saying before, we've been heavily focused on the US numbers.
Yep.
But today in the news, you were highlighting the need to pay much closer attention to Europe going forward. So what's really driving that?
So in Europe, there were surprise numbers where the inflation they thought would be coming down strongly. January was 8.6, and new figures are showing 8.5%. So it's not moving despite 50 basis point moves. The markets previously were pricing in 25-point moves for March and May, and with these inflation figures, the market's now turned around and said 50 each time. But what's interesting, and where this sticky terminology has come back into the news, is it was in the ECB's notes where they've said core inflation and other measures of underlying inflation were likely to be stickier, with only limited evidence of stabilisation so far. So they're basically seeing that, despite the fact that energy prices are dropping, everything else is still going up. So that's despite the interest rate rises. So the market is now saying euro much stickier in inflation, things aren't dropping, and therefore the rates are going to go up higher faster.
So can you maybe dig a bit deeper into that? What are some of those other factors that are really causing that to be sticky, particularly in Europe? How does that all work together?
Well, so another theory, which is probably appropriate here, is called the menu cost theory.
Right.
And this theory is that when a firm has to reprice its menu or its goods, there's cost involved. So people don't want to do it very often. So you want to limit how often you do it. Now, coming into 2022, we've gone from talking about transitory inflation to 10% inflation in a lot of places, and inflation that's not going down. So what firms start to do is they start anticipating these price rises, pricing them in advance, and it sort of feeds into inflation. So you've got all these uncertainties that firms are pricing in. So you've got the Ukraine energy shock, you've got global climate shocks, you've got China's lockdown, which now we're out of, but you've got the supply chain shocks that happened over COVID. So there's so much uncertainty for companies pricing goods and doing that to change their pricing continually is a costly thing. To rewrite the board of McDonald's is a costly thing. So these firms are pricing in advance, and it just self-feeds. So despite the fact that these energy costs are coming down, there's still so much uncertainty. You've still got the war going on in Ukraine. We had the Chinese balloons being shot down all over the world. So there's some political uncertainty. You've got wages. They're talking about wage spirals, which I'm not sure I agree with as much as is being promoted in the news. But these firms are listening to all of this and going, actually, 10% this year doesn't sound unreasonable. And then it self-feeds.
And it's interesting, actually, just re-diverting the conversation slightly to the Australian context, because I was reading this morning that Jim Chalmers, the Australian Treasurer, was saying, really putting the blame back on businesses to some degree and saying, make sure you're not taking advantage of people pushing those prices forward. So the exact scenario that you're talking about. But he's not really factoring in that it's not so much taking advantage as you're describing it there, as really just making a sensible business decision on the basis of high levels of uncertainty. So it'd be quite reasonable for the business owner to push back on the treasurer and say, well, give us more certainty, and then we don't have to factor in as much buffer because it has been so uncertain. We have to do that.
That's exactly right. And, tell me a political scene at the moment that doesn't have this uncertainty. Monetary policy in itself creates the uncertainty where people don't know how much, firms don't know how much they're paying for money because it keeps going up every month. So that's another feed through. And in Europe and the US, like we've talked about, where you've got these fixed term mortgage rates for 30 years, 40 years, consumers aren't the ones that are moderating or having to deal with the monetary policy, it's firms. So it's just another feed through that firms have to price in.
And it is important to understand that from the firm's perspective, they're not necessarily just taking advantage because they're being sensible. It does make sense.
I'm sure there is some of that, but
of course there will.
It is,
but
it's pretty high risk to be setting prices and having to redo them every 3 months because of a crazy inflation environment.
Yeah, and I agree with that. So what does this mean for the dollar index? Because switching sort of back to that Euro US cross, where they intersect is the US dollar index. It's heavily reflecting what happens in the euro, as that's a major component of that basket of currencies that make up that index. So what can you maybe talk a little bit about what's happening with that US dollar index, and then from that maybe talk to us a little bit about what you see happening with the price of gold, because there's a correlation there, I know, that is quite important.
Yeah, so everyone always talks about gold being dependent on inflation, and no one wants to buy gold when inflation's high. There is no such correlation. So you can look that up. It's very, very loose at the best of times. Gold is generally correlated to risk on, so wars, or the DXY in a negative way. So the euro right now, Europe has a much higher level of inflation, and they are going to have to raise their rates accordingly, so probably more so than the US. Now, the euro makes up 57.6% of DXY. So when you've got
very strong part of
DXY
component,
So when you've got the DXY probably having a lift because of what's going on a drop because of what's going on in Europe, commodities usually react inversely to that. So there was a prediction from Jeff Curry, who's the global head of commodities at Goldman Sachs. He's saying commodities up 43% this year. And if gold does react the way that it normally does to the DXY dropping, it should go up Now, it doesn't mean the Aussie's going up, because we are a
Mm.
little way off at the moment on what's going on in the rate world. We're at 3.35%. Europe's now looking to be at around 3.75% by May.
And as you've talked about before, it's just a massive chasm of a gap between where we are and where the rest of the world is.
Yeah, Europe's probably similar to where Australia is at the moment, but they're gaping higher, and Australia is not gaping at the same rate they are. So, likely that these commodities at the moment are going to follow the euro.
And that could be an ideal setup in some ways for us here, because we've got the double push then of strength coming into gold itself, but also from you're not necessarily arguing the Aussie dollar's plummeting, but from an Aussie dollar that's weaker comparatively, it could see an extra boost for us in local terms for gold price.
That's right. Just comparatively, the other thing is, euros at the moment will probably be strong, so against the Aussie. So yeah, exactly, that should be better for Aussie gold. Aussie will not probably follow gold up as strongly as it normally does.
That's great. Alex, thank you so much, as always, for your timely analysis on this story today. You've been consistently warning us that we weren't on the right side of this whole situation yet, and now it's changing a little bit again, but the data's always continued to support what you've been saying. So we always appreciate you being on top of it all for us. So thank you.
Oh, well, thanks for having me again.
Thanks also to everyone for watching. Remember, reach out with any questions or comments for Alex, myself, or anyone else in the team on social platforms. Someone will get back to you as soon as they can. That's us for today. I'll be back later in the week, and we have that all-important interest rate decision from the RBA tomorrow. So we'll no doubt be looking at that. So stay safe out there in those markets, everyone. See ya.